Hi everyone, welcome to this sixth lecture already on shareholders and employees. We're going to discuss two chapters today. That's chapter 6 and chapter 7 of the book. Chapter 6 discusses the position of shareholders and ethical issues that are linked to this stakeholder group. And chapter 7 discusses the position of employees, also a very important stakeholder group if we consider ethical issues in business. I will start today's lecture with a discussion of shareholders, and then the second part of today's lecture will discuss issues related to employees. So I hope that you're looking forward to this. So, a question to you, who do you think are the most important stakeholders in business? Of course, we've already mentioned two, or I just mentioned two, shareholders and the employees, but I'm sure that you can also come up with many other stakeholders. So I'll give you a couple of seconds. So it might be that you've also come up with customers or the competition, think of suppliers, the government. But I guess that employees and shareholders are one of the most, let's say primary groups that you will think of. Shareholders as the main owners of the firm, and of course the employees as those, probably one of the main resources that a firm has to produce the products or to provide the services that they are providing. So today we're going to look at these two shareholder groups. And it might be good to know that in the next lecture, we're actually going to zoom in to another stakeholder group, and that is the group of customers. So that's something that you can expect for in next week. So what we're going to discuss today, shareholders, the position of shareholders, and in that will be of particular interest is the relationship between the owners of the firm, the shareholders, and the managers of the firm, the CEOs. So we're going to discuss the issue of corporate governance into detail, after which we'll go into sort of financial ethics, and also touch upon the issue of globalization and sustainability, how that influences businesses. In part 2 of today's lecture, we're going to look into the position of employees, right? What is their position? What are the ethical issues that arise if we think about employees working in an organization? And to do that, we're going to delve into the concept of employee rights. And this will be very familiar also to the concept of human rights that we've been discussing in lectures 2 and 3 of this block. And we'll also touch a bit upon the issue of globalization and sustainability. Right, so that's what you can expect for today. So let's start with chapter 6, shareholders and business ethics. So in the first lecture, I don't know if you can remember this, but we discussed two views of the firm there, the shareholder view, and the stakeholder view. And these were two rivalry views of the firm, if you can remember. And the first view, that of the shareholder view of the firm, one of the main proponents of that view is Milton Friedman. And you can also see him here on the slide. Milton Friedman was a very influential economist, and he proposed an argument in which he argued that the sole business of a firm is to increase profits as long as it stays within the rules of the game. And with that he means, right, the institutional framework, the laws and regulations that are set by the government. So in that sense, he said, well, the only thing that a business needs to do is to be profitable and act in the interest of the shareholders, the owners of the firm. And his argument actually boiled down to three concerns. And I don't know if you remember this, but I will take you through it again. Right, so he proposed that only human beings have a moral responsibility for their actions, and therefore the corporation does not. Second part of his argument, and that is of particular interest for the discussion of today's lecture, is that he proposed that managers So the executives of a firm, their responsibility is to act solely in the interest of the shareholders, right? So managers are appointed to make a profit. They have to run the business, are appointed by the shareholders, and that is their sole task, right? They need to maintain a profit in the business. And a third proposition that Friedman actually proposed is that social issues, right? So think about poverty, crime, and other problems, that is really the province of the state rather than corporate managers. And so it should not be the case that managers or businesses are actually dealing with issues, social issues, outside of the corporation. Managers can and should not decide, that is what Friedman claimed, what is in society's best interest, right? So we have an elected government in most countries, and through that election process, the government represents the citizens of a country, and therefore only the government can decide on sort of how to spend tax money, right? So managers should not do that. And you may of course question whether this argument holds true, and we also discussed in lecture 1 various counter arguments to each of these three propositions, right? So the notion of CSR, for example, proposes that corporations do have social as well as financial responsibilities. And also the stakeholder view of the firm would argue that there are other stakeholders besides the shareholders whose interests should be taken into account, right? So it's not the manager's sole responsibility to act in the interest of the shareholders, but there may also be other stakeholders that are important when you're managing a corporation. So you may think of employees, suppliers, right? So all these stakeholders that I started off with in the beginning of this lecture. Right, so today we're going to focus on the relationship between shareholders and the managers of a firm. So just to sort of sketch the background or maybe the context, and you might remember the financial crisis in 2007 and 2008, that in the aftermath of the financial crisis, many governance scandals arose. You might remember the bankruptcy of companies such as Enron, and there were many other companies where financial irregularities came to light. And the main problem was that these subprime mortgage market repackaged loans in such a way that managers, so the ones who would be selling those packages to other investors, they would actually receive a higher wage depending on their sales, right? So they had an incentive to sell packaged loans or repackaged loans in order to get a higher bonus, irrespective of the risk of those loans. And at some point when the market started to shift, rather than growing all the time, but starting to decline, the whole market, the housing market, collapsed. At that time, these loans were of course sold regardless of the high risk that they actually involved. And it seemed that the managers that were selling those loans were free to do anything, even act against the interests of the shareholders of the firms, to make sure that their salaries would, that they would benefit of these loans. And of course, you can question here whether these managers of these companies like Enron actually acted in the benefit of the shareholders, the owners of the firm. Well, I would be very inclined to argue that that was not the case, right? They were acting out of self-interest, you might argue. They were acting in such a way that they benefited, but not the shareholders. And at a larger level, of course, the whole economy of the United States was harmed by their acts. So let's have a closer look at how shareholders and the managers, the executives of a firm, actually relate to each other. So if we think about shareholders and managers, they both have their rights and duties. Um, and the relationship between shareholders and managers is a very peculiar one. And it can be characterized by a couple of characteristics. But you could say that the control of the property, right? So the property is of course owned by the shareholders, but the control lies not in the hands of the owner, the shareholders, but lies with the director or the executives, right? So the shareholders own the corporation and the director or the executive controls the organization. Ownership is also fragmented over many shareholders, right? There are most often many different shareholders that own a company. And also the functions and the interests are divided, right? The interests of the shareholders are not necessarily the same as those of the managers. Shareholders often want to make a profit. They want to have dividends um, given to them based on the profits of the organization. Whereas managers sometimes also have their own ego that they want to fulfill, right? They want to have status or prestige depending on the acts that they choose. So given these characteristics, shareholders of course want to protect their investment, their ownership by certain rights. And these rights have mainly to do with the actions that they can take, not necessarily with the right to a certain amount of profit. And in this, the slide lists a couple of these rights of shareholders. And these rights are very useful because they can use these rights to sort of direct the managers or the executives into a certain direction, right? So they can sell their stock if they do not agree with a certain direction, or if they're afraid of losing their money, they can sell their stock. They can vote in the general meeting to oppose or propose certain proposals. They have the right to information about the company, and we will later on today also see that it's not always the case that shareholders and managers have the same information to their disposal. So it can be that there is an asymmetry of information in this relationship. They have the right to sue managers if there is some kind of misconduct. And there are some residual rights in case of the corporation's liquidation, right? So if things would go down south, managers do have some residual rights that they can claim based on their ownership of a part of the firm. And so these rights, they are there to protect the shareholders and to give them some sense of control of their ownership, irrespective of the fact that managers are actually the ones who direct and control the day-to-day operations of the firm. Managers, on the other hand, are trusted to run the company. Right? Shareholders own the company, but managers are in charge of running the company. And with that task, also certain duties arise, right? So they have the duty to act for the benefit of the company. And this links to the short and long-term financial performance of a firm, right? Ensuring that a company is financially viable and can continue to run both in the short and long run. And this links, of course, to the survival of the firm. The second duty is that of the duty of care and skill. And this implies that managers need to ensure that they run the company both professionally and effectively. And the third duty is that of diligence. And this is a notion that managers should be actively engaged in companies' affairs. It's a legal term, and this legal term, of course, also has certain connotations in the legal sense, but more generally, it implies that it gives managers a duty to invest in every possible effort or every possible way in the company, right? So they are responsible for investing their efforts in running the company. So the duties for managers, especially if you compare them to the rights of the shareholders, these duties are quite broad. And this is not accidental, it's actually something that was done on purpose. By framing the duties of managers in a broad sense, we give shareholders the right to step in and also the opportunity to step in when they do not agree with how a company is being run by the managers, right? So they have the space to step in when needed. Well, irrespective of the duties and the rights of shareholders and managers, there are still many conflicts that can arise in this relationship between management and shareholders. It's a very delicate relationship. And all the issues or the conflicts that might arise in this relationship is described in the study of corporate governance. And this deals with this, well, relationship between shareholders and management, and details the rules, the processes, and the structures through which corporations are directed and controlled in the interest of the shareholders and other stakeholders. Right, so each continent actually knows its own type of corporate governance, depending on the institutional arrangements in a country or in a continent. We, for example, know the Anglo-American model, which focuses on the stock market as a central element in corporate governance. Whereas if we look at continental Europe, there are also other stakeholders that are often playing a role. And then you can think of employees and banks, etc. So let's have a closer look at the relationship between shareholders and companies. So if we look at a company, we thus have ownership and control split between two stakeholders, the shareholders and the managers. And as we just discussed, each of these two parties have their own rights and duties, right? The owners, the shareholders, have the right to step in. They have the right to voice their concerns, whereas the managers have the duty to take care and to efficiently manage the firm, right? And these are very difficult to align sometimes. Owners might want different things than managers. So the issues that arise in this relationship have to do with the principal-agent relation. The shareholders are the principal, they contract the management and are the owners of the firm, whereas the managers functions as the agent to the principal. And there are two issues that actually characterize this relationship and can also sort of give rise to some of the issues that are so typical for this relationship between shareholders and managers on the other hand. So the first one is a conflict of interest. As I already mentioned, it can be because of these different positions of both stakeholders that interests are not aligned, and actually they might be in conflict with each other. The shareholder, on the one hand, of course, wants the managers to perform tasks for them, to do things with their property and to manage that effectively. Managers, on the other hand, also have interests that, well, of course, have to do with the company, but they may diverge from the interest from the shareholders. So shareholders often want to seek profit, right? They want to receive dividends on their investment, and they just want to have a company that performs well, right? That would be beneficial for the returns to their shares. Sometimes this may also imply that managers need to put in more effort than the manager actually wants to put in. And it might also imply a low salary or a lower salary, because the higher the wage of the manager, the lower the profits. Managers, on the other hand, want a high wage, a high remuneration. They would like to seek power and self-esteem, right? And this sometimes implies that they might take actions that are not in the best interest of the firm, but may add prestige on their own account. And then you can think of certain mergers and acquisitions that a manager, for example, wants to pursue, which are not necessarily in the interest of the firm, but could look very well on their own CV. So that is the first problem, the conflict of interest between the shareholders and the manager. And the second problem that often arises in this relationship is that of an informational asymmetry. And I already mentioned that a couple of slides ago. The manager, who is of course running the company, is probably aware of all the processes and issues that are at stake within the company, right? They are running the day-to-day business, and therefore they are aware of all the issues that are playing in the firm. The shareholder, on the other hand, even though they have the right to information, they are not always aware of everything that the manager knows, right? They have limited knowledge and insights into the agent, into what is happening in the company, but also into the qualifications of the manager, their goals. And it could be that the manager is, well, pursuing certain things that the shareholder is not aware of. So in a sense, the information is asymmetric, where the manager often knows more than the shareholders. And these two, well, issues give rise to this very specific relationship between the agent and the principal, and can give rise to conflicts between these two. So over the years, and I'm sure that you've also read about examples of such issues, but we can find many examples where the agent went into the wrong direction and exploited the information asymmetry that exists between the principal and the agent. And I've listed some of these examples on the slide here, but you can come up with, I think, many others yourself. This is an example of one of the biggest fraud scandals in 2020, where a CEO of Wirecard was actually fraudulent and laundered a large sum of money that eventually also led to insolvency of the company. And here you see, this is of course a major example where apparently a CEO, the agent, did not put in his best effort and did not manage the firm effectively. So how can we actually align the interest of shareholders and management, right? So the principal and the agent, such that we can circumvent some of the issues that might arise due to this asymmetry of information and the difference of interest or the conflict of interest that might also exist between these two. So the book actually mentions two solutions, and I want to go into these two solutions now with you. So the first one has to do with executive accountability and control. And this has to do with the organization of the board of directors. And the idea is that next to the executive directors who are in charge of running the corporation, right? So the management that we have just been discussing, we can also indicate or set up a separate body of people, the so-called non-executives, who ensure that the company is being run in the interest of the principal. So this is the principle of accountability and control, where you have a board that consists of two types of executives, executives and non-executives, and the non-executives check and control the executives. Of course, if you think a bit about this, for this to work, you need to ensure that the non-executives do not have an interest in the company and should be independent or neutral to the company. So they cannot have a financial stake in the company, for example, but also they shouldn't become too familiar with the executives, because that might also give the executive the opportunity to influence the neutrality of the non-executive. Another solution is that of executive pay or executive remuneration. And the idea is that you can try to align the interest of the managers to that of the company by linking the salary of the manager to the success of the company. Right, so on the slide it also says, well, you should pay executives in the same currency that matters to the shareholders, dividends and options to buy shares. And if a manager has this incentive, it will also try to make sure that the company is profitable and successful, as that will also be profitable to the manager itself. So the linking of executive pay to the company's shares is not a very new thing. And as you can see in the graph on the slide, this is something that was already done in the 1970s. And this graph shows for the 350 US ranked firms, if we rank them by their sales, how much of the CEO compensation is linked to the shares, right? So including salary, bonuses, and stock awards. And you see that over the last couple of decades that this really has risen, at least the amount of compensation in millions of euros. So the graph already showed us that over the past decades, executive compensation in terms of shares has risen substantially, right? And we can also see if we look at some numbers that in the US, the average CEO salary was 15.6 million, and that was 270 times more than the US average salary. So CEOs, if they're doing well, right, that's the condition, can really earn a substantial amount and a substantial amount more than an average worker. And also in many European countries, you actually see the same, even though this gap is much smaller, right? So in 2018, for example, the highest median CEO compensation for Europeans was in the Netherlands, which amounted to 8.8 million. So substantially lower than in the United States, but still a huge gap between the average worker and the CEO. Right? So remember, a key element in executive remuneration is to align the interests of the shareholders to that, sorry, of the managers to that of the shareholders by paying the manager in terms of dividends and share prices. And often, something that I did not mention yet, this is done by also giving them futures, which is the option to buy shares in the future, right? So they have an incentive to perform well in the future such that then they will benefit. And this of course works only, that is the condition for this to work, if this payment is sufficiently high. Right, so we see that perhaps over the years payment has risen, and therefore also the gap between CEOs and workers, even within the same company, has risen substantially. And this graph shows that, right? It's the CEO to worker compensation ratio based on options realized and granted. And it shows us that since the 1965 over to 2018, we really see a substantial rise in this ratio, right? So a typical CEO in the United States makes 278 more than a typical worker in the same company. Of course, you can question whether this is ethical, right? Is this something that we find is a just distribution? So there are some ethical issues that are linked to executive remuneration, and this has especially to do with the rise of CEO salaries over the past decades, as was shown in the previous graphs, right? Because part of the share options, in order to align the interests of the managers to those of the shareholders, this part needs to be sufficiently large, right? And this has been growing over time. And therefore, in the end, CEOs, the salaries of CEOs is skyrocketing. Salaries are increasingly increasing and sometimes even outstrip shareholder returns. So they tend to make more money than an average shareholder in the company. The skyrocketing salaries of these CEOs also tends to cause unrest within corporations and societies in general. You may have heard of questions, of debates within your country about whether a high CEO bonus or a high salary of a CEO is justified. I know in the Netherlands we have had multiple of such discussions over the past year. And I can also imagine that if you consider that a CEO is making 278 more than an average employee, that you of course start to question the fairness of such a high salary. Another development that is also linked to this is the global pressure which drives up CEO salaries internationally. It's a global market. CEOs can move between countries and companies, and therefore they tend to move to a country and a company where they can earn the most. And this, of course, drives up salaries, even in countries where the salary was generally or relatively low. So even in the Netherlands, where we do not really have this tradition of high executive remuneration, salaries are also rising. And even here we have the question or the debate whether we want to incentivize managers in such a way. And an example of this was in 2008, was a fairly recent controversy in the Netherlands where a Dutch bank, ING, at some point abandoned the plans to award a 50% pay rise to their CEO after a political uproar. So there was a huge political and societal discussion about the rise of a pay of a CEO of the Dutch ING bank. And eventually, this political and societal unrest led ING to drop the pay rise. Well, I think this is a very striking example of how a solution to the principal agent problem can actually also, again, yield other ethical discussions and dilemmas, right? So it's not a one-way fix to this principal agent relationship, unfortunately. So if we consider some normative arguments for executive pay, and then we'll also end the part on corporate governance and the principal-agent relationship, is that if you consider some of these ethical theories that we've been discussing so far, you can imagine that a utilitarianist would, for example, propose that a high salary of a CEO is actually justified because it would otherwise not be, you would otherwise not be able to attract talent if you would pay any less. I wonder whether this really is a valid argument, right? Because also from a utilitarian perspective, you could propose that using the CEO's salary and distributing it over a larger group of people would eventually yield more happiness and less pain, right? Thinking about the marginal utility of money, of course, giving €1 of a CEO to a low-paid worker would make this low-paid worker much happier than the CEO who already has a lot of money. If we think about theories of rights and justice, we can of course again look at different theories within this category. So Rawls, who developed a theory of justice, would question, well, what actually is a just distribution? And if you remember, he had two principles of justice, and one of these principles described that we can have inequalities in our distribution, and these inequalities are justified if they are at the benefit of the least well-off. So you could argue that a CEO is justified to earn a high salary if also the low or the least well-off, so the workers who are not paid a lot are actually benefiting from this. So also their salary needs to go up a bit. And in that scenario, a high CEO salary would be justified. We can also look at a non-egalitarian theory of justice. And there we would say, well, we do not need to have an equal distribution, but a CEO is actually justified to a high salary if he or she earned it in a fair and free market. Right? So if you are entitled to your salary, you worked hard for it, and you did not commit any corruption or fraud, then you're actually justified to earning this salary. And we can also look at another theory. Let's look at virtue ethics, and there we should ask ourselves, well, what would a good manager or a virtuous organization do? And then we also get very quickly into a discussion on, well, what would be a good salary, right? How much should you earn, or how much do you need to earn to live a good life? And you may propose there that the CEO that earns a very high salary, that is actually something that does not lead to well, a balanced life, to a virtuous life, but actually goes very into the direction of living a life of greed, right? Becoming greedy, earning more and more rather than being satisfied with what you have. And greed, of course, is not a virtue. So you might propose an argument there that such a high salary is not a virtuous way to live your life, right? So a good manager or virtuous organization would probably pay wages that are not exorbitantly high, right? So that's a set of normative arguments to consider if you think about executive pay. And of course, I would invite you to also use some of these other normative ethical theories and link this to this question of, well, whether a high CEO salary is actually justified, ethically justified. Let's go into the next topic that is linking to shareholders, and that is the topic of financial market. Because of course, financial markets also link to the principal agent problem, as they are based on shareholders expecting a future dividend or rise in share prices, on which they decide or determine their decision to buy or sell stocks. Right, so the owners of the firm become an owner of a firm by trading in a financial market. Thinking of a financial market, you may propose that there are not really any ethical issues here, right? The financial market, as long as people stick to the rules of the game and the market is free, people can access and enter the market, the outcomes are fair, right? But this assumes a perfect market, and it's also described on the slide. A perfect market is a market where all publicly available information about a company is reflected in the stock price. The idea that if everybody would have the same amount of information, the stock price would indeed reflect this. But we know that information is not always perfect, right? And that is linked to these two examples on the slide. Speculative faith stocks, that's actually a phenomena that, again, I'm sure that many of you are familiar with. And this is based on not on the performance of a firm. So these are stocks that are not linked to firm performance, but they are based on the speculation on future performance. And then, of course, you think of many startup firms in Silicon Valley who are firms with a great idea, a great message, but most often they don't really perform yet. They don't really live up to the expectations. However, if we look at the financial markets of these startups, their stocks are really sometimes skyrocketing. And we call those speculative faith stocks, right? There is faith in the company that it will at some point perform well, and this reflects in the stock price. And you might also argue that these faith stocks also played an important role in the financial crisis of 2007-2008, where people were also expecting that the housing market would continue to rise, right? That was sort of the condition for these subprime mortgages to still be profitable. When houses would still increase in price, people would not really lose any value on their mortgages. And if that would indeed be the case, right, if the faith in these stocks would have been justified, we would not have faced a problem with these subprime mortgages. Another issue that shows that we do not have a perfect market is the example of insider trading. And insider trading occurs when people buy or sold securities on the basis of non-public information. And again, this would be information that not all the participants of the market have. And this yields an unfair advantage. You might have information about a firm, about a manager that is going to move away, or maybe someone is attracted to a firm. And on the basis of this information, you are more suited or more informed to make a good decision on the financial market. So often for executives of a firm or another insider that is located within a firm, such information can be very useful because it gives them a privilege, right? So it gives an unfair advantage. And again, not all public available information is the information that is available to all the traders in the financial market. And this links, of course, to the issue of fairness, right? Is it fair when some people have more information to their disposal and therefore can make a better or a more informed choice? Well, we can debate about that issue. So also here, right, thinking about these faith stocks, some examples and also a clip if you're interested in watching it, is the example of Tesla, which of course has been proposed to be a speculative bubble, right? A company that hasn't really performed, at least for a long time, it did not. And there was a lot of speculation about well, this company becoming really profitable in the future, which of course influenced the stocks. Another example where you can think of if you consider whether the financial markets are perfect markets is the example of short selling. And also there you might, well, if people start to short sell, is the idea that you profit of a decrease of a share, that you sort of gamble on the future expectation that a share is going to decrease, so to loss, then you might also wonder whether this is actually ethical to do, right? Is it ethical to gamble on the expected losses of a firm? And last year we had this example of GameStop, where also a lot of players started to short sell. And there was this huge discussion on whether this is something that is ethically justified. Well, another example, just to illustrate that markets are not perfect. So the examples of faith shocks, insider trading and short selling show that it's not always the case that we are in a perfect market in which people can make informed and autonomous decisions. Right? Traders should be able to make autonomous decisions under free market conditions, such that they can weigh the pros and cons and set their goals, right? So these information asymmetries that are existing, as shown by these examples of faith shocks, insider trading, and short selling, give rise to another set of ethical issues. Is it fair that some people have more information than others? Is it fair to gamble on expected losses of a firm, etc.? Well, how can we counter this? So there are some agencies that are installed to make sure that information is shared or information is available to all the traders within a financial market. And these are credit rating agencies, CRAs, and they are there to provide a fair view of the financial situation of a firm or to judge the trustworthiness of an investment. So they are there to set up a bridge between these information asymmetries and shareholders and the corporate actors, such that, well, probably we cannot really attain full information for all the actors, but we can try to at least increase the information that is available to all the actors. So the idea is that this provides a more true and fairer view of the firm. And I'm sure again that you are aware of some of these examples, some organizations that are credit rating agencies, such as Moody's, Standards and Poor's, which are well, most of the sort of well-known examples of organizations that deliver such credit ratings. So these three big agencies are not without criticism themselves. So some would actually claim that they were the main culprits of the financial crisis, as for a long time they did not adjust the credit ratings of these subprime mortgage-based securities. And the question then, of course, rises, can we actually trust these credit rating agencies? So there are also some problems with credit rating agencies. And in the book, there are 5 problems listed. I would just like to discuss 2 of them here today. So the first one is that these CRAs have a lot of power and influence in financial market. They're very powerful. There are not many of them. So in that sense, there's also not a lot of competition that challenges the power of these CRAs. And of course, if things go well, it's not a problem that they're influential. But what if they do get things wrong, as what happened in the financial crisis of 2007, 2008? Then power and influence does become a huge problem, right? As the whole financial market system is based on this. Another issue arises because there can be conflicts of interest between the CRA and their clients. Right? Often clients and the CRA are very close, or the CRA is very close to the companies that they rate and evaluate. Sometimes they even act as a consultant to their clients. And of course, this also jeopardizes the neutrality of the CRA, which should be a neutral company. Moreover, and this is, I think, even more problematic, CRAs are paid by the issuers of the financial products, not by the investors in whose interest the ratings should have been conducted. So CRAs have a very strong incentive to provide good ratings to their clients rather than doing so in the interest of the investor. And that's also where this example on the slide links to, right? What if a butcher hired their own meat inspector with the power to set their prices and fire their inspectors if they do not like the inspection reports that are issued? So that's how the CRAs often work, right? So the CRA also has an incentive to give a good rating to the client rather than giving some kind of neutral and objective assessment of the client. And here we also have an example of the Dutch context where the Dutch Financial Authority, who supervises the Dutch market, argues or urges supervisory boards to improve their oversight of accountants. So also in the Dutch smaller financial market, we have issues very much that are related to the ones we have been discussing for, well, most often US-based market where these credit rating agencies are based. So we have been covering already a lot of different topics today linked to shareholders, the principal agent problem, the ownership structure within a corporation, and how we can align the interest of shareholders and the management by, for example, giving them or paying them partly in terms of shares of the company. And we have been also looking at the role of the financial market. I want to discuss two more topics today. One is that of the globalization of financial markets, and another one has to do with the power of shareholders in changing corporations. So bear with me. I know it's a long lecture for today, but we're almost there. So I think it's, well, we cannot really deny that globalization has had a crucial impact on the role of shareholders, on corporations more generally, as global equity and financial markets are among the most globalized markets that we know across the world. And this, of course, changes the role of shareholders if we think about how companies are owned, what kind of activities they take up. So, and you may question, of course, well, what is the role of shareholders in a market that has become increasingly globalized? So shareholders, by being a shareholder of a multinational company, may become directly or indirectly involved in buying shares abroad, given that companies are located in different countries. So being a shareholder of a multinational company makes shareholders, if they want it or not, a player in the global capital market. And this may come with certain responsibilities, right? Ethical issues linked to that are multiple, but I want to discuss a couple of them here today. And the first is linked to governance and control. And I think this is, well, a problematic issue, right? Normally we have a market within a nation, and this market is regulated by the governmental regulations that the government installs within that country. And of course, as a company that is operating in a country, you have to abide to the rules and regulation of the country that you're operating in. Considering the globalized financial market, there is of course no government who is responsible for this market and the rules and the regulations that take place in the market. So there is nothing else rather than sort of the laws of demand and supply that can govern this market, and this can sometimes lead to negative consequences. Again, the financial crisis could be an example here, but there are many other examples that you can think of. Also linked to this is that, and that's something that you may not think of, is that many government-owned funds of countries also invest their budget surpluses in the global capital market. Right, so what if these funds start to invest in companies for motives beyond the maximization of value? In the Chinese example is, I think, very striking here, where you see that Chinese investment funds start to invest in strategic ports. Well, you may wonder whether it's something that we would like to, or whether this is something that should be regulated. Another issue that arises if we consider global financial market, then we should also acknowledge that because there are no regulations for this market, it can also be easily used for illegal transactions as there is no control. And the Panama Papers, of course, displayed a lot of these unlawful transactions and actions that, well, that have been taking place. But this is really also something that we should consider, right? So even though the globalization of the financial markets has many benefits, right? Shareholders can become an owner in companies in different countries. Money can be, well, the dividends or the returns to money can be higher when money can flow across borders. We should also acknowledge that the lack of rules and regulations may also give rise to negative consequences. And well, some of them I just discussed here on the slide. So the globalization of the financial markets we just discussed, rules and regulations or the absence thereof, also gives power, renewed power to the corporations that are active in this globalized market. If national governments do not have any saying in these markets, it might also mean that corporations become stronger and even have sometimes power that governments would normally have. And this idea gives rise to the firm as a political actor. And please note that this goes against this argument that I started the lecture with, Friedman's argument, who proposed that companies do not have a social role, right? That only governments should have a province about what is happening in a society. Well, you may argue that due to globalization, this of course changes. What if rules and regulations of the government no longer apply to a globalized market? Well, then it could be that corporations need to step in and become a political actor. Considering the nature of the firm, right? A corporation is owned by the shareholders. That also means that shareholders really have a powerful position in a firm from which they, of course, may be held accountable, but they can also start to challenge company policies, which involves the governance of citizenship. And this is actually where the notion of shareholder democracy comes in. And that is the idea that shareholders are a community of people who have an important stake in the company and are able to influence it. Shareholders, more than other stakeholders, have a legally protected claim on the corporation. They are owners. And corporations are accountable to their shareholders. And this means that shareholders can actually try to influence the course of action of a corporation by using their shareholder rights, right? They can vote, they can propose policies, they can buy shares, sell shares, etc. And by doing so, they can push for more social accountability and more social performance within a firm. So shareholder activism is a way to exercise the rights of you being a shareholder and to voice concerns of social, ethical, environmental issues. In that way, shareholders can try to change actions and practices of a company. Socially responsible investment is very much linked to this concept of shareholder activism, and that is also the use of ethical, social, and environmental criteria in the selection and management of investment portfolios, generally consisting of company shares. So it's the idea that investments are not just done with the aim of financial returns, but you can also invest to achieve ethical, social, or environmental goals. So shareholders are looking for profitable investments that also aligns to other criteria. And that could be a positive criteria like conservation or environmentalism, equal opportunities or diversity, but it can also be a negative criteria, right? The absence of animal rights violations or the absence of child labor, the absence of investments in weapons, etc. Right? So it's the choice of investing in a socially responsible way, not just leading your investment portfolio by financial goals, but by goals that are linked to ethical or socially responsible aims. And I'm sure that all of you also know this example of Shell, which has received a lot of news where shareholders tend to become much more active by using their voting rights. And that is one way that shareholders can, within a company, try to promote goals that are linked to ethically, socially responsible aims. And I would say that this is something that we also see much more often over time, as is also displayed by the graph on this slide. So to become or to invest in a more socially responsible way, there are also some tools that you can use to find out whether a company is actually performing towards this broader goal of sustainability. And there are various indices that you can actually use for this. One of them is the Dow Jones Sustainability Index, which assesses companies on the basis of environment, economic, and social sustainability. Another index that you might also have heard of is that of the ESG goal measures, which again also scores companies on the basis of their environmental, governmental, and social performance. And these scores, so the Dow Jones Sustainability Index, but also the ESG score, score companies on the basis of their sort of social environmental performance. And it's very useful for socially responsible investment to have a look at these scores and see, well, how a company performs on the basis of these indices. One question or one issue that you should realize when using indices like the Dow Jones Sustainability Index or the ESG score is that they might be based on questionable data or questionable criteria. So data depends, of course, on the availability of information that a company provides. And you can imagine that not all companies have the incentive to be open and transparent about the information that they want to share with a company that is making these indices. And you can also wonder, well, what kind of criteria are in these indices, right? Are these criteria that are really useful? What do they really measure? And again, of course, what you want to measure should be transparent and should be an indication of really a socially responsible investment. And again, that's not always the case for such indices. And here a small excerpt of an article of the Financieel Dagblad in the Netherlands, which also shows that the green investment of which you, well, thought it would be green may not be so green after all. And the reason for that is, well, these two criteria, or these two problems that I just mentioned on the previous slide, right? There may be questionable data. Companies do not always have the incentive to provide all the data necessary to construct such an index. And you may also question whether the criteria itself are useful, right? So what do they really measure? And is it really an indication of socially responsible investment, or are they actually picking up something else? So with that, I would like to end today's, or the first part of today's lecture. Let's take a break, and then I'll see you in a bit to discuss the topic of employees and employee rights. Thank you for your attention.